Palantir just reported 63% revenue growth, a record 51% operating margin, and billions in free cash flow over the last year. That is the kind of performance you'd expect from a stock people call the future of AI infrastructure. So why did the stock dump nearly 7% in a single session? In this video, we're going to cut through the noise and answer one question. Is Palantir an incredible AI business trapped in an overhyped stock, or is the market simply catching up to reality? No hype, no drama, just the numbers, the risks, and what they actually mean. If you're serious about AI and tech investing, this is the kind of breakdown you want. We're going to look at how good the business really is, why the valuation scares a lot of people, and how macro and interest rates are driving these wild moves. This is not financial advice. I'm not telling you to buy, sell, or hold Palantir. I'm giving you the facts and the context so you can make your own decision. Let's start with what Palantir actually delivered. First, forget the stock price for a moment and just look at the business. Palantir's latest quarter was the strongest in its history. Revenue came in at roughly $1.18 billion, up about 63% year over year and 18% quarter over quarter. The adjusted operating margin hit around 51%. That's elite for any software company, let alone one growing this fast. The company is consistently GAAP profitable now, and trailing 12-month free cash flow is in the multi-billion range. That's not a someday we'll be profitable AI story. That's a real business with real cash. Now look at where the growth is coming from. US commercial revenue, the private sector side, exploded by roughly triple-digit percentages year over year and nearly 30% quarter over quarter. US government revenue still grew more than 50% year over year, which is huge for a segment that was already large. Total commercial revenue is now bigger than government revenue, and it has stayed that way for multiple quarters. That's an important shift in the story. For years, Palantir was known as that secretive government contractor with spooky data software. Today, it's turning into something different, a high-growth, high-margin AI platform company serving both governments and large enterprises. On paper, if you just look at the income statement and the cash flow, Palantir looks like the kind of business investors dream about owning for a decade. So what's the problem? The growth isn't coming from thin air. It's coming from Palantir's AI stack, especially AIP. AIP is essentially Palantir's engine for plugging AI models into real-world operations. Companies start with a small proof of concept, maybe one workflow, one team, one use case. And in a matter of months, they scale to full organization deployments, finance, supply chain, operations, risk, all wired into one data layer with AI agents sitting on top. Palantir is also rolling out AI agents and tools, things like HiveMind and AI-driven development environments that help customers plan complex missions, optimize logistics and inventory, speed up internal software development, detect patterns in messy, real-world data. Then you have the defense and government side, which is still one of Palantir's biggest competitive advantages. The US Army is moving more and more of its data and analytics work onto Palantir's platforms. Partnerships like the one with Exeger focus on supply chain visibility and readiness, which is critical in modern defense and geopolitics. Internationally, certifications like IRAP in Australia open the door to more government and regulated customers who can't just deploy any random cloud tool. So when people say Palantir is becoming the operating system for Western data and AI, that's not just marketing. There is real substance behind that line. And yet, despite all of this, the stock can still fall hard on a random Thursday. Why? Because of the price. Let's talk about the part most bulls don't like to hear. Palantir is a fantastic business that happens to trade at very demanding valuations. Even after improving, its valuation metrics are still in a league of their own. Depending on which period and metric you use, you'll find things like a price-to-earnings multiple that's hundreds of times earnings, not tens. EV/EBITDA and EV/sales ratios far above what you'd normally see even for high-quality, profitable software companies. Meanwhile, many solid software names sit around 20 to 40 times earnings, and they're not exactly junk businesses either. So what is the market assuming? It's assuming that Palantir will keep growing very fast for many years, maintain very high margins at the same time, avoid any major execution missteps, No big regulatory blow-ups, no huge contract losses, no long stretch of disappointment. That's what priced for perfection really means. When a stock is priced this richly, great news often just keeps it where it is or pushes it a bit higher, because a lot of that good news was already expected. Any disappointment, or even a wave of fear in the broader market, can trigger a sharp repricing. And that's exactly what we've seen. You can have a quarter where Palantir beats expectations, raises guidance, and posts record margins. And the stock still sells off hard because the market suddenly shifts its focus from AI future to interest rates and valuation risk. This brings us to macro. Palantir doesn't trade in a vacuum. It trades in a world where investors are constantly recalculating what future cash flows are worth if interest rates stay higher for longer. Every strong jobs report or sticky inflation print revives the fear that central banks won't be able to cut as fast as the market hopes. On those days, growth stocks with high multiples get hit first. Palantir is one of them. So when you see a day where the tech sector is down around 3 to 4%, the broader market is down maybe 1 to 2%, and Palantir is down 6 to 7%, it's not necessarily because something broke inside the company. It's because the market is questioning the price being paid for that future growth. If you own or are thinking of owning Palantir, you're not just signing up for AI exposure. You're signing up for macro sensitivity and volatility. Bigger upside moves when AI sentiment is hot. Bigger downside moves when rates and valuation fears dominate the headlines. That's the trade you're making, whether you acknowledge it or not. So what do analysts and insiders make of all this? On the analyst side, the message is pretty consistent. Many analysts are positive on the business. They like the AI leadership, the government relationships, and the profitability. But they are split on the stock at current prices. Some have buy or outperform ratings with targets higher than today. Others stay neutral or even negative because they're uncomfortable with the valuation risk. In other words, Wall Street doesn't argue much about whether Palantir is a good company. The argument is about how much is already priced in. On the insider side, you see something similar. You have directors selling meaningful blocks of shares worth millions of dollars, which tells you they're happy locking in profits at these levels. At the same time, those same insiders still hold very large stakes, which tells you they haven't given up on the long-term story. It's not a they're dumping everything, run for the exits picture, and it's not a nobody ever sells a share fairy tale either. It's exactly what you'd expect from people who believe in the business, but also understand risk and diversification. So let's put all of this together. Here's the most honest way to look at Palantir right now. The business is outstanding. Fast revenue growth, high margins, strong free cash flow, real traction in AI, defense, and commercial enterprise. The stock is demanding. Valuation is still very rich. The price already reflects a lot of future success. It's highly sensitive to interest rates, macro shocks, and sentiment. The risk profile is clear. If Palantir keeps executing, grows into this valuation, and strengthens its position as the AI backbone for Western institutions, the upside can still be substantial. If growth slows, margins compress, or the market re-rates high multiple AI names, Palantir can drop hard, even if the business is still good. So the real question isn't, is Palantir good or bad? The real question is, are you comfortable paying a premium price for a company that might actually deserve it, but will punish you if anything less than excellence shows up? That's a personal decision about risk tolerance, time horizon, and conviction. If you found this breakdown helpful and you want more data-driven, no-nonsense analysis of AI and tech stocks, consider subscribing, hitting like, and let me know in the comments. Are you bullish, bearish, or just watching from the sidelines on Palantir right now?